What is up, YouTube? This is the Working Investor. In this video, we're going to talk about something called whipsaw, which is one of the weaknesses when it comes to the cover call ETFs. And what is whipsaw, and how can you take some steps to mitigate losses that come from whipsaw? And we're going to talk about new funds that are coming out from YieldMax. They made an announcement on their X page, and how these funds I'm very excited about. And I really want to take a look at them because one of them may have some whipsaw protection insurance built inside, in my humble opinion. Everything here is not financial advice. This is just my personal opinion, my personal journey. Let's get into the video. So let me give you an example of what whipsaw is, right? So let's look at Tesla. And you see Tesla, we're going to go year over year. And you see Tesla had a lot of ups and downs. But of course, overall, it did a great job going up. And if you type in compare and we type in Tesla, let's type in Tesla, right? So this is a YieldMax fund that does synthetic cover calls. And the good thing is they give good income, but the bad thing is that they, as you see here, the yellow is the Tesla, and you could see that they pretty much captured all the downside because they have the synthetic lost money. They took the roller coaster ride all the way down together with Tesla. But the riskiest thing is that when the underlier goes up, because it's a covered call or synthetic covered call strategy, it caps the upside. So it will take the whole roller coaster ride down with the downside, but you can start seeing that it starts diverging right here around April when it starts going up. You see, that's where there's a divergence, where the blue, which is the underlier, is actually outperforming, right? And that is a risk, nothing to do with YieldMax. That is a risk with cover call strategy or synthetic cover call strategy. Let's also compare TSLP, right? TSLP. This is a curve ETF. And I actually was thinking about possibly hedging my bets just as an idea, just throwing an idea out there. I'm not telling you to do this. Curve also does cover calls, synthetic cover calls, like YieldMax, but a little bit different. They write their calls a little bit further out of the money, so they have a ability to capture more of the upside. So their value of their price goes up more because they capture more of the upside. So you can see here that all three, all three of these underliers, they track together on the way down. Where you see the differences and the delineation is on the way up, right? So sometimes I was thinking to myself, maybe I should own, if I have Tesla, maybe I need to, my biggest risk, I'm not afraid when the market is flat. I'm not afraid when the market goes down because, that's the risk I'm taking. And I'm not afraid if the market goes up gradually. But if the market goes up really quickly, those reverberations, we call it whipsaw, you don't get to capture that upside. So one idea was to own, Curve, which captures some of the upside. But again, Curve itself will also, even if you write your cover calls further out of the money, even as an individual investor doing it yourself, you're still going to, cap out. That's the trade-off, right? So let's talk about other ways how I was thinking about some ideas how to prevent whipsaw. I call it whipsaw insurance. Again, this is just a theory, just try to put some information out there. Just do your due diligence, do your research, you take your own risk. Let's get into some of these options. So here you could see some methodologies that I'm thinking about, just brainstorming. And if you have other methodologies of mitigating whipsaw, feel free to share. I love to learn from everybody. So one thing is YieldMax a few months ago started building into their funds the ability to write call credit spreads to capture a little bit more income. So, that's why no other fund that I know of, no other income, option-based income fund does this. So they're able to sometimes mitigate some of the loss of the potential upside by doing these call credit spreads. I mean, it could cost money, but it's something that they do to help built in recently in the past few months. Another idea, and I've seen a lot of investors do it, is they actually own the corresponding underlying stock. So if you buy, in FIVY, then some, which is the income fund, some people would actually own NVDA, and maybe a small portion of it. So when the market does that the reverberations, you're able to capture the upside. You're capped on the income side, but you're not capped on the asset side. So it kind of helps mitigate some of the loss that one could find themselves. Another thing, and I was thinking about this one too, is to own the leverage underlier. So let's say there's a lot of risk with leverage funds, but the reason why I like it and I'm attracted to this is because of capital efficiency. Because for me, I'm trying to make a lot of income from these income funds, and when I have an asset that I'm just holding for equity purposes, but not for income purposes, it's kind of slowing down my goal of making income. So I'm trying to figure out if I could do capital efficiency. So if I have, let's say, for example, I have an income fund that's based on the NASDAQ. Let's say I have QDTE, right? Which is the Roundhill product. They do 0 day to expiration cover calls or synthetic cover calls with overnight exposure. And let's say I have something called TQQQ, right? So TQQQ is the triple leverage NASDAQ 100, and it has 3 times the momentum, right? So if I have, let's say, one portion of TQQQ and 3 portions of QDTE, it would kind of be one portion of TQQQ has 3 times the capital efficiency of owning the QQQ outright when it comes to playing the momentum. Now the thing is that timing is very important. That's something you have to be very cognitive of. Like I said, I don't like the way I'm thinking about my theory of this, and I'm not telling you to do this, is I don't feel like I need to necessarily hold these funds the whole entire time, because I'm not worried when the market is kind of slowly moving up, inching up, or kind of staying within a range, which is range bound, or even going down or staying down. My biggest concern is when the market shoots right back up, if there's some kind of momentum play going on. So maybe when the market's beaten down, maybe if I want to capture the upside, that's something that I'm thinking about, with these possibly utilizing these kind of strategies. You can go even one step further, and one could even do, let's say, a leap. If you do a leap on a triple leverage product, you can own them for a fraction of the price. Let me give you an example. So you could see over here the TQQQ, actually they're pretty much almost at all-time highs right now. So I wouldn't want to touch this at the moment. I'd rather buy low, sell high, right? Not buy high, sell low. But let's say, for example, I was thinking, let's say we're at the bottom of the market, or we're like, we have a 30%, the market went down 30%, and I want to get into TQQQ. So right now I would have to pay, $89 a share time, if I want to get 100 shares, I would pay $8,900. And again, this is a triple leverage product. So even though it's $8,900, it represents almost like almost $27,000 worth of QQQ in momentum. But if I do a leap, let me show you. So I'm doing trade options. Let's say I want to go all the way out to January 15th, 2027. And I'm going to do buy call. And let's say I'm looking for a 0.8 delta, 0.7 delta, let's do 0.75, right? Right over here, 0.75. So I could do the $77 call, buy it out. It's for January 15th, 2027. And I'm paying $33.85. So I'm paying less than half the price, right? I'm paying less than half the price, and I'm controlling 100 shares of the triple leverage product. So now instead of putting out $8,900 in cash and having that sit there doing nothing, I'm only putting out $3,385 in cash, just a fraction of the price, and I'm still controlling and appreciating that upside. Granted, I'm a 0.75 delta, so for every dollar up, I would appreciate about 75 cents on the dollar, but as it goes further up, it will become deeper in the money. So now, effectively, I'm pretty much, because it's a triple leverage product, and this is at least half the price, if not less, I actually have 6 times capital efficiency on my money. So that's crazy. That's crazy. So I don't have to put so much money into my insurance policy. That's what I want to talk about. And now I want to talk about this last strategy of FIVY. We're going to focus on FIVY, and this comes from the YieldMax ETFs. They put out something on X. Basically, they're announcing that on December 17, they're going to have two new ETFs coming out. One is called FEAT and one is called FIVY. And it looks like that each of them are going to have five underlyings. They're using something called the Dorsey Wright strategy. And the Dorsey Wright strategy is a very interesting strategy. And I'm going to show you a reference that I found. So here's the overview. I found some Freedom Advisors. Outperformance through adaptability. The approach transcends market timing, emphasizing strategic positioning to be overweighted in sectors and stocks exhibiting robust relative strength. The Dorsey Wright systematic relative strength core model is designed to adapt, identify opportunities, and construct portfolios that have the potential to outperform across various market conditions. In navigating the dynamic landscape of financial markets, Dorsey Wright's commitment to systematic relative strength positions investors for sustained success. So they're basically, here are the four parts of the four steps. So basically, I mean, you could read it, but they just first of all look for a sector, and they're trying to find a sector that it's promising, and they're trying to find what's hot right now, what's pumping right now, and then they're looking for within the sector. They're trying to rank, mid cap, large cap. They're trying to use lots of data to find out which, within the hot sector, what's specific is happening in there. And then they have now this is interesting, the dynamic portfolio adjustment. So there are funds out there let's say the Mag 7 fund. So a lot of different companies have Mag 7 funds. Great, but the thing is that, what happens if one of the Magnificent Seven, I mean, it used to be called FANG, and then it's going to change. It's going to change. Things are dynamic. There could be a new contender up there that's going to beat the Magnificent Seven or should be rightfully within the Magnificent Seven. So this thing constantly has the flexibility to adjust. So let's say if you have a company that says we're looking for the top five, companies out there. We're not saying that we're not locking down. We're not married to specific underliers, but whatever the data shows is the best ones at this time. We're gonna evaluate and kick out ones that don't fit and put in things that do fit. So that's my favorite part about it personally, for my own opinion, the dynamic portfolio adjustment. And then they select stocks. I mean, I know that they talk about the 20 to 25 stocks, but I think in YieldMax they're doing around 5 stocks. And let's go down to these two ETFs that YieldMax sent out. And we'll keep an eye on it. I'm going to keep a close eye on it December 17th when they come out in a couple of days. Let's go back to the YieldMax X page. So here it almost looks like they're saying FEAT and FIVY. They sound the same. They seek to track the performance of the NASDAQ Dorsey Wright Tactical Option Income Strategy Index. They both kind of do the same thing. But when you go down further, they kind of break down what each of the funds do. So let's look at what FEAT is, and we'll look at what FIVY is, in which I'm interested. I'm looking at the FIVY as I like both, but with what it seems like, they both look interesting. But FIVY seems more interesting for a whipsaw, protection type of thing. Not saying it's always going to work, but it's something that I'm looking into for that purpose. So FEAT is, again, that's the consists 100% of the 5 yield, and you'll see why I say 100% of the 5 YieldMax ETFs that correspond to the 5 highest ranked underlying securities. So they have some kind of ranking system. You know what I mean? I know a lot of people go in for the highest dividend yielders, or so I guess I'm interested to see. Now, the number one thing I always say, an ETF is a basket is only good. It's only as good as the parts that it contains, so an ETF is only good into what it contains. So I'm really, really interested to see what is comprised of FEAT and how, and then see if I like it, and then I'll decide if I'll make a move on it or not. And then the FIVY, Now look at the split. So it's the same thing as FEAT. They're looking for the that they're the five highest ranked ones, but it's not going to be 100% just yield max. It's going to be 40% of the actual underlying securities. So, for example, they'll own Tesla and maybe some Tesla. Maybe they'll own Amazon and AMZ, and maybe Nvidia and FIVY, etc. Right? So it's going to have 40% of the underlying securities and 60% of the five corresponding yield max ETF. So it's kind of will be like it's kind of built into the fund that you own the outright and you own the cover call. That reason why I am attracted to this is exactly because in my theory, I'm looking for ways to mitigate whipsaw, trying to make sure I'm trying to fill that gap up. One thing, with the yield max one compared to the leverage funds is that the capital efficiency. I mean, you have to admit, if you're using 40%, let's say you have $100,000 into one of the FIVY funds, that means that 40% is not going to produce any income for you in the fund itself. You know what I mean? Of the fund. So obviously you're going to get lower. You're going to trade off lower income from the yield. But the trade-off is you get more growth. That's pretty cool. You get to capture some of the growth. And the trade-off is the whipsaw. If the market goes really fast down and then it goes really fast up, you won't be capped out if you're holding the actual underlying security within the fund. So that's actually really cool. And then, like I said, an alternative would be just holding the fund 100% outright and then maybe doing my leaps. But the stressful thing with leaps are timing the market, knowing when to come in, when to buy the leaps, when to get out of the leaps, I mean, I like it in a way because I don't have to waste capital or buying power on protection while the market's good. And I could select when I want to use that buying power when the market takes a tumble, right? But then I have to worry about timing. But then also like with capital efficiency, like I said, doing the leaps on a double or triple leverage product, it's 6x capital efficiency. Right. So it's hard to say, it's really hard to say. I'm just thinking about all my options. If you have any ideas of how to mitigate whipsaw protection, like I mentioned earlier, I'd love to hear from you guys. I love learning from everybody and sharing what I know. Anyways, again, so look at all my disclaimers, not a financial advisor whatsoever, just putting out some theories out there, just something to look into further. I hope you guys have a wonderful weekend and a wonderful trading week. This is the Working Investor over and out. Be well.